Good afternoon, welcome back. This afternoon we're going to have Anthony Booth on the phone from BMT Tax Depreciation Specialist, a very good friend of ours down here at Cohen Handler. So I've just got a few questions here for him. Thought it was very appropriate considering it is coming to the end of financial year. So we're just going to give him a ring now and he'll answer our questions for us. Hi Anthony, how are you?
Good, mate.
That's good to hear. So I just had a few questions for you quickly.
Sure.
Just to kick things off, what is property depreciation?
Basically, property depreciation is a non-cash tax deduction that all property investment owners are entitled to claim. As the ATO allow us here in Australia to negatively gear property, part of that is property depreciation. So basically it's the wear and tear of the assets and the value in which they lose every 12 months. The investor can claim as a deduction off their annual tax returns. So basically the four walls, the roof and the floor, plus all the bits and pieces within the home, so carpets, blinds, kitchen appliances, hot water systems, as they get older they suffer from wear and tear, so they lose value every 12 months, and that's what we're able to provide as a depreciation deduction basically.
Okay, and typically how much can you save? I know it's hard to say, but just, if you were to cast out a broad figure, how much can you save on these deductions?
Look, on average, we find that between $5,000 to $10,000 in the first full 12 months is available to claim on most properties. Now, that's both new and old, and obviously as an average. But look, the newer the property, the higher the deductions are going to be. If you were to purchase a brand new 3-bedroom house for $600,000, you could be looking at between $11,000 to $12,000 worth of deductions in the first 12 months. And even, at the 37% tax rate, that's between $4,000 to $4,500 back in your pocket alone in the first 12 months of ownership.
Yeah, absolutely, a massive saving if you're an investor. Now, do you or anyone from your company or your team inspect the property?
Yes, every inspection that we carry out, every report that we carry out basically includes an inspection. In some cases where we've had previous experience within, say, a unit complex, we don't need to reassess every single time. But for established homes, commercial properties, all those sorts of things, we engage one of our staff members to go out and do an inspection on that property, and we use that as documentation to back up, obviously, the client's claims, and also to show where we've come up with the figures for the depreciation schedule itself.
Okay, cool. And generally speaking, how long does it take from the time that someone's made an inquiry with you to the time that they have their schedule back?
Look, it's always a variable with how long it does take, but look, from the day of inspection, we guarantee a 5 to 7 day working turnaround time, only for the fact that obviously properties may be tenanted or hard to get access to. So look, it could be 2 weeks from the date of initial contact, but once we've been out and had a look at the property, no more than 5 to 7 working days to complete that report for them.
Okay, and do they only really need that report come tax time, or is it used to them, say, in March or January?
They can organise the report at any time. Typically, the accountant won't need to see it until tax time.
Yep.
The other good thing is, too, it can be used for, to help assess your weekly pay-as-you-go tax variations as well. So if you do see your accountant mid-year or later in the year, as long as you've got that information ready to go, they can complete your return and certainly plan for the future for you.
Okay, and cool. And how old is too old to claim property depreciation?
With that question, it's something that does pop up quite often. Basically, it doesn't matter how old the property is, there's going to still be some form of depreciation attraction in there. It just comes down to how long they've owned that property for. So if you were to buy a 1920s Federation home today, it could still be in original condition or renovated over time. It would still be worthwhile in getting done. But if you were to, say, own something from the 1960s and you were looking to claim depreciation on it today, there wouldn't be much in it unless you were to purchase that same property day, we revalue all the fixtures and fittings upon settlement, and we also look at putting costs and estimates on renovations that have occurred in the past.
Okay, so that sort of leads me into my next question. If a previous owner has renovated the property and then, say 5 years later you bought the property, can you still claim depreciation then, or?
You certainly can. Even though someone else has paid for all the work to be done, you're not going to miss out. So what happens there is you buy an older property, someone's completely gutted it and refurbed the insides. There's no cost information available. We can walk in as quantity surveyors, we can estimate the work that's been done, and you as the new owner can rightfully claim depreciation on it because there's still X amount of years running on the lifetime of the assets, but also on the structural components that have changed. The kitchen will run for 40 years, it might only be 10 years old after being replaced. You're still entitled to claim the next 30 years of depreciation on that kitchen itself. So renovations are another fantastic way of claiming depreciation.
Okay, and just to finish up, I just wanted to clear up a rumour. There's been a few whispers around the company that you've once upon a time claimed depreciation on board games and knives and forks. Is that fact or fiction?
That's fact. Basically, that applies to, any property, but you'll see it amongst fully furnished, whether it's holiday let, we're in a hotel pooling setup. Basically, whatever's within that property is part of the income-producing property itself. So things from your furniture, your beds, your linen, your TVs, fridges, all those sorts of things, right down to your knives and forks, your crockery and cutlery, computer consoles, your board games. So even the good old family favourite Monopoly, it's going to suffer wear and tear over the years, and you can still claim depreciation on it as part of your income-producing property.
Okay, fantastic. Well, there it is, straight from the horse's mouth. Thanks very much for your time, Anthony. No doubt I'll speak to you soon. And,
no problem.
Not a problem at all. Have a lovely afternoon.
Mate, if you need anything else, let me know.
Okay, thanks very much, Anthony.
Thanks, Henry.
Bye.
Bye.
So there it is, tax depreciation explained by Anthony Booth. If there's anything you're not sure about, feel free to write in. Alternatively, of course, Anthony's details will be down below, so just give him a call and definitely have a chat to him and see if he can help you in any way. Thanks for watching.